Hello everyone. Welcome back to the channel. Today, we're diving into the important topic of capital budgeting, what it entails, why it's essential for businesses, and the major techniques employed, all explained through relatable real-life examples. Capital budgeting is a critical concept for students in commerce, MBA programs, and finance-related fields, so let's get started. Capital budgeting is the systematic process by which companies evaluate long-term investment decisions. Whenever a business contemplates investing a significant amount of money, whether purchasing new machinery, expanding its facilities, or launching a new product line, they rely on capital budgeting to determine if the investment is justified. The need for capital budgeting cannot be overstated. First and foremost, investment decisions often involve substantial funds, which means that mistakes can be costly. Additionally, these decisions tend to be irreversible. Once a company commits its resources, it can be difficult, if not impossible, to backtrack. Furthermore, these decisions significantly influence the long-term profitability and survival of a business. Given that resources are finite, firms must strategically select the best projects to maximize their potential returns. Now, let's explore the various capital budgeting techniques. The first technique is the payback period method. This approach focuses on determining how quickly the initial investment can be recouped. It is particularly beneficial for companies that prioritize liquidity and wish to mitigate risk in uncertain environments. For example, imagine a company invests 10 rupees lakhs in a new machine and recovers 2 rupees lakhs annually. In this case, the payback period would be 5 years. This method is favored by businesses with shorter cash cycles who need to ensure quick recovery of their investments. Next, we have the accounting rate of return or ARR. This method assesses profitability based on accounting profits rather than cash flows. It becomes useful when management aims for a straightforward comparison of profits using financial data. For instance, if a project generates average annual profits of 1 lakh rupees on an investment of 5 rupees lakhs, the ARR would be 20%. Companies often utilize this technique for internal reporting purposes. The third technique is the net present value, or NPV, method. NPV evaluates the present value of future cash inflows minus the initial investment, helping to assess the potential to maximize shareholders' wealth while accounting for the time value of money. To illustrate, if a project requires an investment of 10 rupees lakhs and its anticipated cash inflows have a present value of 13 rupees lakhs, the NPV here is 3 rupees lakhs. Because this NPV is positive, the project is considered viable and accepted. Then we have the internal rate of return, or IRR. This rate is defined as the point at which NPV equals 0. It is employed by companies looking to compare the returns of a project against the cost of capital. For example, if a project shows an IRR of 18% while the company's cost of capital stands at 12%, this indicates that the project is a worthwhile investment. The Profitability Index, or PI, is another concept. This method illustrates the value generated for each rupee invested, making it especially valuable when firms are experiencing capital rationing. For instance, if the present value of inflows from a project amounts to 120 rupees while the investment is 100 rupees, the PI would be 1.2, suggesting the project is indeed profitable since it's greater than 1. Finally, let's touch on the discounted payback period. This method is a variant of the payback period, as it takes into account discounted cash flows. It is used when companies want to recover their investments early while factoring in the time value of money. If the discounted cash flows manage to recover the investment in 4 years, that time frame becomes the discounted payback period. In conclusion, capital budgeting is vital for businesses as it guides them in utilizing their funds wisely, reducing risk, enhancing profitability, and making well-informed long-term decisions. Each of the discussed techniques serves a unique purpose, and it is common for companies to apply more than one method to reach a final decision. If you found this explanation helpful, please like, share, and subscribe. Thank you for watching.